Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Poniotu, certified financial planning professional, the Cap and Capitalize. In today's episode, we are going to talk about what you need to do with an inheritance. Now, before we get into it, the free tip of the day, this is planning advice. And it kind of ties into what we're talking about. Regularly update your will. So again, this ties into today's episode of what you need to do when you inherit money. But let's say that you have been successful in your own right. Or even if you're not considering yourself financially successful in your own right, you know just by listening to the show, you're on your way to being like not broke. And so because of that, you want to make sure that you have your ducks all in a row. Now, your loved ones are going to thank you for taking I'm going to say 30 to 60 minutes to get a basic will set up. I mean, sometimes you can even go online and do it through like a LegalZoom or whatever the case is. We've seen clients do that, and then there's some issues with paperwork. Now, obviously, I can't give legal advice, but I can kind of go like, dude, wink, wink, nudge, nudge. This is a really crappy will. You should probably go talk to an actual professional to get this done. So by taking that 30 to 60 minutes, you pay at a minimum a couple $100 and you're good. You're going to save your family a tremendous amount of grief and heartache. Technically, if you don't, it doesn't really matter because for this point you would be dead, but like that's neither here nor there. So, anywho, let's get into what you need to do with an inheritance. Everything you need to know about what you need to do with an inheritance. Now, I want to break down a couple different amounts of inheritance, and then we're going to enlighten you, by we I mean me, on what you need to do depending on how much you inherit, okay? Because there's three types of inheritances. There's small, medium, and large. I know, really creative marketing on my part. Obviously, what consists of small, medium, and large is relative person to person, right? Like one might think something is a lot, another might think something is a little, etc. But from an absolute term, like 10,000 is 10,000. Okay, 5,000 is 5,000, a million is a million, whatever the case may be. When it comes to absolute terms of the monies that we're dealing with, it gets very black and white of what you should be doing with that money that you are getting, okay? And also, you know, my team brought this up right before, and this is a really good point. A lot of people assume when you inherit money, that's just because like you have like really wealthy family members, and that is not the case. It definitely helps. Like it helps if your family is friggin' loaded, but just because, you know, you inherit money, you could inherit it from someone you may not even know. You could inherit it from a friend or, you know, like a distant family member that somehow knows who you are and you've never met them before. You laugh, but like it happens. So that's just a note. You don't have to have just like a wealthy family to get an inheritance, okay? So when it comes to like small amounts of money, I want to give a couple examples of what I mean by that, okay? There's like the $5,000 or $10,000, $15,000, even up to $50,000, okay? And again, I'm not saying that's a small amount of money, but relative to the numbers we're going to talk about later on in the show, it's smaller, okay? Now, are these numbers that I was rattling off life-changing in the long run? Yes and no. You know, if you inherit $10,000, that's not going to set you up for life, okay? It might give you some cushion. It's not going to set you up for life. Even up to $50,000, you know, you can invest that and maybe you can kickstart your retirement sooner if you invest it and compound it accordingly. But again, it's not going to set you up for the rest of your life, so to speak. But there are a number of things that you can do with the $10,000 to $50,000 range. Okay, of course, $5,000 and all that. So if you have not already done so, you need to have your emergency fund all set up. So if you don't have 3 to 6 months set aside for an emergency fund, guess what? That's probably where that money should go. Because if you do have an emergency before you inherited the money, you're kind of screwed. Now you're no longer screwed. Funny how that works. Now, you could also contribute to an IRA and or a Roth IRA. If you're married, you and your spouse, you could do $7,000 each, okay? And, what's also kind of cool is, let's say that you inherit the money early in the year, like before taxes are due. You could contribute for last year as well as the current year, okay? It's kind of nice. Now, this is a little bit more advanced, and you got to think about it. You could max out your 401k. So let's think about this. Let's say you inherit $23,000 and you're under 50. Why don't you contribute 100% of your paycheck into your retirement plan? You're going, well, then I won't be making any money. Right, but wrong. Because what you're doing is you just inherited 23, and then you're contributing your paycheck, 100% of it, until you max out at 23. So by the time you fully maxed out your retirement, basically your inheritance, it's a way to disguise it through the IRS of taking that money and contributing it to your retirement plan. Now, can you do that directly? No, because with a 401k or 403b or 457, for those of you that unfortunately work for the government, you have to contribute with your paycheck monies, okay? But by taking that inheritance, setting it aside in your checking account, it will dwindle over time, which allows you to get the max benefit for your retirement plan in that year, okay? Hopefully that makes sense. Now, and then one more. Forgot to say this. If you've got high interest rate debts, you can knock those out too, okay? That's great. Now, when it comes to medium amounts of money, now this is a pretty fat range. Okay, I would say anywhere from $75,000 to a couple $100,000 to $300,000. This is where it starts to get interesting. Obviously, that range, like I said, it's pretty wide, but it's a no-brainer. Now, there's a big difference between inheriting $10,000 and $300,000. Like a big difference. $290,000, not to be counting, but I digress. So with the small example that we discussed earlier, obviously all of that still applies. Okay. But the major difference is with more money, you can add on to things to do. So let's say that you inherit $300,000. This gets to be a little gray with what you could do, and I'm going to explain it. I'm going to explain it right now. So let's say that you get this money and you're in your 30s. Okay, you got a young family, mortgage, some student loans. When it comes down to the interest rate side of things, because again, you got to know, and actually our last episode, we talk about interest rates with debt a ton of what you do when you have no money, or you can go way back and listen to Capitalize Your Debts, okay? But when it comes down to the fact that you're in your 30s, you got this long-term time horizon. Hopefully you don't die anytime soon, okay? Shout out to me who just turned 33. It's one of those things where does it make sense to just wipe out a low interest rate mortgage or pay it down substantially, but you still have the mortgage payment? Probably not. Because we know in the long run, assuming that you invest prudently, again, past performance doesn't guarantee future returns for you compliance geeks out there. We know in the long run, it would probably be more prudent to take that $300,000 and assuming high interest rate debt isn't part of the conversation, you'd probably want to invest that for the future, whether it's for your kids, again, for this specific example, young family, 529 plan, setting kids up for college, or private school for pre-K, middle school, high school, trade school, and or just investing it for the long haul, I wouldn't be opposed to that at all. Now, if you're in your 40s, same thing. Same thing applies, okay? Obviously, you're a little older, your family's a little older, but same applies. Now, if you get that $300,000 in your 50s or your 60s, this is where the game changes a little bit. Obviously, I'm not saying people don't have like young kids. I mean, Janet Jackson had a kid at like 50, but like normally that doesn't happen. You're closer to retirement, like a lot closer. And so, when you're thinking about that, the game will change when it comes to tax efficiency in retirement. And this is really, really critical for you to understand before we go to the commercial break. So let's say that you inherit that $300,000. You're in your late 50s. You're going to retire at 60 before anyways. And all things being equal, that just sped up the retirement side of things. Well, let's say that you've got $500,000 in your retirement account. Okay, just making it really, really easy. $300,000, like that moves your needle a lot. So in the short run, because before you inherited that, all of your retirement money, you're just going to be paying ordinary income tax on that, no different than your W-2 job, assuming you work for someone, okay? So there's really not a lot of tax strategy involved. However, if you had that $300,000 in non-retirement money and $500,000 in retirement money, you could take that retirement money, and what we call in planning is we front load the tax inefficient dollars, and you get the ordinary income tax, which is the highest tax brackets, out of the way sooner in retirement. And as you're doing that, you can delay your Social Security. You can delay taking money from that $300,000 that is taxable, which will be capital gains. And so what's happening is you're going down in tax bracket every year in retirement, because as you're spending down that $500,000 of 401k money, the $300,000 capital gain, it's growing. And so what did we also just do? Not only did we add a tax efficiency aspect to your retirement, we just layered in now a wonderful estate planning strategy for your kids and grandkids. Because if they inherited your retirement account, they have to withdraw that money within 10 years. Or by the end of the 10th year, excuse me. If they inherit the non-retirement money, they get a step up in basis. So if you have $300,000 and it grew to $1.2 million when you hit the pearly gates, okay, that gain of $900,000 is all capital gain. But if it goes to your heirs, that step up in basis starts at 1.2. So you hit the dust, they inherit 1.2, they could sell it. They owe squat when it comes to taxes, versus they would pay a lot of taxes on the retirement side. So I know we went from 0 to 100 really, really quick, which is perfect timing for us to take a break and go to the commercial break, because after we do that, we're going to talk about the big dollar amounts, like $500,000 and beyond. So stick around, and we'll be back shortly.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotu, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. I know right before we went to commercial break, we were talking about small and medium-sized inheritances, which again, I know there's a range, right? And it's different for everyone. Well, we're going to close out this episode with just a whopping inheritance, okay? Large amounts of money, I would say $500,000 and beyond, okay? Because objectively, like, that is a boatload of money. So as I stated before we went to the lovely commercial break, and the amazing sponsor, unbiasedly, of course, everything that we mentioned for small inheritance and medium-sized inheritance, it still fits for the large inheritance. But we get to add even more to your plan. So in the $500,000 range and above, your plan is going to be, it's going to be very similar to the medium sizers. I don't know if that's a correct, yeah, we're going to say that's correct vocabulary. The medium sizers we talked about earlier. But if you're getting into like the $1 million range and above, that's where it's going to get interesting and fun. Minus the fact that someone died for you to get that money. But like that's beside the point, okay? If you inherit $1 million, that is universally known that that's going to be life-changing. Like, there's no denying that. Like, I don't know anyone that's going to be like, yeah, that doesn't really move my needle. Unless, like, someone is already successful in their own right. So if you're in your 20s, 30s, or 40s, this could kickstart your retirement decades earlier if you plan accordingly. And so let's say that you're in your 20s and you inherit $1 million. I mean, side note, nice, right? But like, how do you grow that? What do you do? I can tell you right now, there's a couple things, okay? So you can invest that in the stock market, and you could invest in whether it's a bunch of mutual funds, exchange-traded funds, commonly known as index funds. You could have a stock portfolio, whether it's just a few or a diverse amount. The point is, you could have the market, okay? You could also utilize real estate. You could utilize private credit, hedge funds, privately owned businesses, private equity. Something that we've talked about a lot in the past is the endowment model, which I'm a huge proponent of in not only my practice, but my own net worth. And it is one of, if not the number one ways strategically to grow one's net worth. And what people misunderstand in the world of investing is you've got people on the stock market side of things and their team stock market all day long. Like, nothing can do better than that. And then you've got people on the private equity side or privately owned business side of things. Okay, it's another term for it. And they're all about that. And then real estate people, especially, and I don't know why, but athletes are just super into real estate. It's neither here nor there. That's all they do, okay? The answer is not an either or, it's an and it works together, okay? And so by utilizing the endowment model, you can supercharge your net worth. Now, another thing you could think about if you inherited $1 million or even $500,000, okay? And I'm not degrading $500,000, but like, there's a big difference between $500,000 and $1 million, literally double. If you're in your 20s, 30s, 40s, or even your 50s, you can max out your 401k like every year for years and just go to the tax bracket, which is great, okay? You could also do contributions to your IRA or your Roth IRA. Generally speaking, if you inherited $1 million, though, you're probably in a higher tax bracket at that point, so you wouldn't be able to contribute per se to a Roth IRA because you make too much. But then if you put money into your IRA and then you rolled it into a Roth IRA the next day, we call that a backdoor Roth IRA contribution. That can be really exciting and fun. And there's a ton of things you can do in the long term, okay? Now, if you have a mortgage, okay, of a couple $100,000 and you inherit $1 million, do we know in the long run, assuming you've got a low interest rate mortgage of 6% or below, do we know in the long run that you could probably earn a higher return than that lower interest rate loan on long-term investments? We know that, okay? Can't guarantee it, but we know it. However, even if you just wipe that out and you get you inherit $1 million and you pay off your $300,000 mortgage, you still got $700,000. Like it just was, it didn't, it didn't move the needle. You still got a boatload of money. So I could argue that, yeah, you could earn better than that in the long run, but also like you were kind of gifted this massive gift. Why don't you be mortgage free and call it good? I wouldn't mind that. Like, I'll tell you right now, if I inherited $1 million, knowing what I know, I'd probably still invest it. But like, I could easily go and say, hey, Steph, I think we want to be mortgage free. Like, I'm just done. I'm done. Okay. Like, either way, I'm good. Okay. Now, if you're in your 50s and beyond and you inherit money like that, you know, that money, it basically banked you into retirement. Like if you're 52, you've been saving, you've been doing well, and you suddenly inherit, and let's say you're worth a couple $100,000 and you just inherited $1 million. Congratulations. You're retired now because you can be. And there's a couple things that you need to think about if you inherit money like $1 million and you're over 50. So, and again, I'm not giving any definitive things. I'm giving you things to think about. Because when money grows, it's not cut and dry. Like money is very dynamic, and you need to be very nimble in the mind when it comes to money. So the first thing I'd think about is, even though you have a will, okay? Because if you don't have a will, like go get a will, like now, okay? Even though you have a will you need trusts set up for your kids or grandkids? You know, that's mission critical. Also, I just realized the will was not an intentional pun, but it was there. It's one of those things, though, where, I mean, let's face it, if you inherit $1 million at 50 and you were on track to retire anyways at 60, and now you retire earlier, the rule of doubling, let's say, you hit the dust at 90. So you go from $1 million to $2 million, $4 million, $8 million, $16 million. Yeah, you're probably going to need some trust set up for the kiddos. Again, not legal advice. I'm just saying life gets complex when you get into the double digits when it comes to millions. Another thing to think about would be, with your new net worth suddenly skyrocketing, will you need life insurance? Now, why would I need life insurance? Like, what's the purpose of life insurance? Great question. I'm glad you asked. Life insurance is for when you have a ton of debts on your net worth statement, and if you, for whatever reason, met Jesus a little bit earlier than you would like, your heirs would not only have all those debts paid off, but you could also invest some of that after all those debts are paid off, and then have the same lifestyle that you had before you greeted God, okay? However, that is traditional life insurance strategy 101. So let's say that your net worth is skyrocketing. Let's go back to that $16 million net worth if you hit the gates at 90, okay, and you've grown your net worth. Well, I am in the lovely state of Washington State. I'm being a little sarcastic here because we have a state estate tax. So anything over $2.193 million as of the year 2024 is taxed with an estate tax. On top of that, as of 2024, if you are worth over $13.1 million, the estate tax is not skinny. It is about 40% of that goes to the government. So you superset that, not to use a bodybuilding term, with the Washington State estate tax. Out of that $16 million, I'm just going to eyeball this here. If you haven't done any planning of sorts, your heirs would get, let's call it 11, 12, something like that, okay? Which, again, you could argue, what are they getting, 11 or 12? I can tell you right now, when family members see that, they didn't grow their net worth to give it to the government. They grew it for their families or charities, okay? Literally anything but the government. So what's kind of cool is, let's say that we know what is, 16 minus, right, the 11 that this hypothetical person would actually pass on to the heirs. That's $5 million that would go, right, as far as taxes to the government. And so what's kind of cool is you could set up something like a irrevocable life insurance trust, an ILIT. And then within that trust, you would purchase a life insurance policy for that death benefit, in this very hypothetical case, of $5 million. So when you pass away and you are worth 16, yes, that tax is owed, but the irrevocable life insurance trust actually pays the tax. So a lot of people, what they make the mistake is they go, oh, I got it. Great. Boom, boom, boom. I'll buy a life insurance policy for $5 million in my name. Wrong. It cannot be in your name. It has to be outside of your estate, outside of you. And that's why you set up the trust. Because if you do set up a policy in your name and you die, yes, you go from 16 million in this case to 21 million, but now you got to factor in the taxes. So all you did was add more of a tax bill. So the government loves that, okay? Literally no one else does. So by setting up the irrevocable life insurance trust, you could avoid a lot of those taxes by the trust actually paying them, and that's a really cool estate planning tool. And again, if you're inheriting all this money, you got to think, right, forward thinking 20, 30, 40, 50 years, your net worth will grow to that. And it's better to do it now than later as far as thinking about it, because insurance policies get more expensive. Because fun fact, the closer you get to death, the more expensive it will be. And then the third one that I want you to think about is, could I guarantee that my monthly expenses are met by using certain strategies? So when you inherit something substantial and you're close to retirement, generally speaking, especially like $1 million or more, that does change the game in a massive way, to the point where, what if there was a strategy where you could carve off a certain portion of your net worth, and that portion of your net worth, in tandem with Social Security, would pay for your monthly needs guaranteed? Now, a lot of people are going, oh, here he comes. He's pitching an annuity. My eyes are already rolling to the back of my head. No, I'm not. I'm totally not. Okay. I'm not an annuity guy. I'm not a real estate guy. I'm not a stock guy. I'm a planner. I'm an actual planner. And it's not either or, it's and with all of these strategies. No different than the endowment model I talked about earlier. And so by utilizing partial annuitization, if you are about to retire or have retired, that actually can add a substantial amount to your net worth in the long run. And not only would it add a substantial amount of net worth in the long run, just absolute, from a health standpoint, there is a ton of behavioral finance research that has come out saying that if someone knows that their monthly expenses are met guaranteed for the rest of their life with a cost of living adjustment, the amount of years that they will add to their life from being not as stressed, it can be as high as a decade, which is huge, which only compounds your net worth further, which means you could even give that much more to your kids or grandkids or charity or charities of your choice. Again, I'm not saying you got to do this. You don't have to do any of this, okay? I'm just saying these are things you've got to think about, because when you inherit a substantial amount of money, you need to understand that is a stewardship of money is a really big deal. Okay. It's a really big deal to, me. It's a really big deal to those that I've worked with that have built themselves up and worked tooth and nail to get to the point where they are financially free. And, it's one of those things where it is a responsibility. It's not just your money where you inherit it and you can just go buck wild. I mean, you can, but you're going to regret that someday. I don't know when, but you will. And so understanding the responsibility of what it means to inherit money like that, prudency always has to be at the top of the mind. And our listeners that have listened to me for years know that's one of my favorite words. So because we're nearing the end of the episode, I'm not going to dive any more into those questions that I wanted you to think about. I wanted to give you a little teaser. I told myself I wasn't going to, and then, naturally me just giving free advice, I couldn't help myself. But if you have any questions about that further, shoot me and my team a message, and I will make a continuation of this episode in the future to dive in more deeply. Really, with that being said, I thoroughly enjoyed this episode. We've actually had a ton of fans messaging us asking like what we need to do with this. So hopefully if you run into this situation or you're in this situation, this will answer a tremendous amount of questions. But like I said, I loved it. I hope you loved it too. I'm hoping y'all inherit this massive sum of money, but regardless if it's small, medium, or large, now you know everything that you need to do when you inherit money. So until next time, keep capitalizing. Talk to you soon. Cheers. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. Earnings from a 529 college savings plan can grow tax-deferred and may be withdrawn free of federal taxes when used for qualified education expenses. Non-qualified withdrawals are subject to a 10% penalty tax. The information provided is based on current laws, which are subject to change at any time. Capitalize Your Finances is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Exchange-traded funds, or ETFs, are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442. Christopher A. Panayiotou is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.